you. Very, very good to see you all. And 2 or 3 weeks ago, probably more like 3 weeks ago, but time rushes, we had Baker talking to Matthew, and we had the most engaging conversation around crypto. I know it was engaging because I got a lot of feedback afterwards from a lot of people. And poor Matthew, who is moving office, moving home, moving everything at the moment, then very graciously dealt with a lot of questions from a lot of forum members. So thank you for that. But here is the opportunity for Matthew to be asking Baker, who we all know from one of the long-standing supporters of Forum. And today they're going to talk about post-pandemic investing in public and private markets. So Matthew, everyone knows the format. We talk for 20 minutes, questions in the sidebar, and then we'll do a Q&A for 10 minutes thereafter. But Matthew, I'm going to bring you in now, please. And if everybody else goes on to mute, and Matthew, take it away, please. Thank you.
Perfect. Thank you, Simon. Good to be with you all again for this talk. It's going to be a fun one because, as Simon said, I get to turn the tables on Baker and ask him all about cryptocurrency in the most detailed way. But the reality is Baker's one of the most thoughtful people and friends that I've had the pleasure of spending time with. And he combines such an interesting cross-section of thinking about macro topics, markets generally, strategies, and just things going around in the world broadly, that I think it's a great opportunity to hear what him and his team have been focused on. So great to have you all with us. As Simon said, we'll spend about 15, 20 minutes with some questions that I have, and then we'll go into broader Q&A. So actually the first question, I was half joking, but it kind of dovetails into the world of crypto, and we touched on it briefly a few weeks ago, which is the topic of inflation. And a lot of crypto proponents, including folks like Stanley Druckenmiller, as recently as yesterday on CNBC, have come out and very vigorously expressed their concerns around inflation in the world. And the mosaic of how crypto fits into that is obviously the Bitcoin as an inflation hedge, as an asset inflation hedge that a lot of folks are turning to. But generally, this question of inflation looms. People are following different types of data very closely. So with that being such a large question, Baker, let's start there. What's your current view on inflation? Where do you see it going? How are you thinking about it right now?
Thank you, Matt. First off, just because I'm regulated, I need to state that these are my personal views, not of Stifel or our affiliates, but I'm glad to be here. And we look at the majority of the inflation we're seeing currently is transitory. We've had nice recession rebound here. We're seeing a rally in commodity prices that's due to the increasing demand. We're seeing a supply cycle disruption, primarily in the maritime space, that if you talk to any importers or exporters, are having major issues. But if you look at the personal income levels, in March, we were looking at 20.9% decrease. In April, we saw a 13.1% decrease as well. And then with the majority of inflation being wage-based, we need to see wage really picking up here. And as the government stimulus slowly ceases in the United States this fall, I think that we'll start seeing whether this is really a true inflationary level or if it's temporary. And I think the big question will be the Biden $6 trillion stimulus package. And if that gets through, yes, that is a seed for higher inflation, probably above 3%. And if it's not fully met, I would expect inflation to be between 2 and 2.5%.
Got it. Interesting. Yeah, it's going to be probably the biggest story that folks are following, especially in the monetary inflation environment that we're seeing with central banks around the world. That's insightful. Let's turn to equities. So risk assets have obviously behaved and continued to behave the way they have through the course of really March of last year through to today. We've seen some spurts of volatility. We've seen some different types of investment styles and strategies that were pushing the markets around that are maybe different than what more traditional investors have seen over the course of history. How are you thinking about equities currently? The S&P as a proxy for that. Do you guys have price targets? Do you have a price target for the S&P as you look over the balance of this year?
I think the S&P is I'd say price for perfection right now. Our price target was roughly 42 to 4,300 for the year. We're trading at 4,200 right now. I strongly believe we'll have some seasonality here with the sell in May kind of thesis that has usually matured. I think we'll have a 5 to 15% correction. I look at 2014 as kind of a mirror of where we are right now. We're up about 12% on the equity markets overall. And we had a negative 7% print on the markets by the fall of that year. And I think we'll have volatility of that nature, given that I think there will be a shift back to fundamentals. I don't think the Biden administration will get all 6 trillion done. And I think the market's pricing that stimulus package already into the markets. But that said, I do see a thesis for slowly pushing this market higher. I think retail trading has actually picked up with the Reddit trading, the ability for apps. I think people in their spare time during lockdown have used new technologies, either through crypto or the Robinhoods, to trade. And I think the average middle class to lower upper class American is starting to realize they want to take more of a hands-on approach with their investing. So we're seeing a lot of money that's been saved over the recession or this COVID era. So I think consumer sentiment is strong. I think the vaccination numbers are strong. I think there is that mentality of a roaring 20s that I'm a bit hesitant of, because the PE ratios in 1929 are where we're trading at right now. Although interest rates were at different levels then, but I would say we're close to those levels for a major pullback of, I'd say, 10 to 15% at least.
Got it. That makes sense. So bringing inflation back into the conversation, how is that driving or informing any of your views on areas of opportunity? Are there certain sectors, are there certain geographies that you see more attractive relative to others, or you have a more bullish outlook on relative to others, given the current composition and kind of macro backdrop?
If my thesis is correct that on a PE ratio, we're trading kind of price to perfection. Obviously, the defensive sectors would be where you want to be going into through the summer. I'm not saying that we should be kind of sell in May and go away. I think we just kind of need to be more defensively natured. I think healthcare, that's been lagging this year, is an interesting sector to be in. I also think consumer staples will be a solid place to be going into some volatility. And I think telecom services that potentially are a bit of correlation with the 5G thesis and technology should do well going forward, as their price margins will increase as people slowly migrate over to 5G.
Gotcha. Another big dynamic tectonic shift that we've seen really over the last 20 years has been the intersection and interplay between public and private markets. And I don't think that's ever been as pronounced as it is right now. When you look at the amount of capital in the world, you look at the way companies are behaving, you look at the way capital is being allocated and deployed, it's really, really fascinating. There's been some really interesting research put out of your shop, out of other places. Michael Malbison wrote a report, I think it was in the last 6 months at some point, about public-private markets and how this landscape has evolved. So again, I go back to kind of the macro backdrop, the potential for rising rates. How are you thinking about opportunities in public versus private markets?
I agree with your thesis that the public and private markets have kind of blurred lines, especially with SPACs. I think the SPAC mania that we started seeing start in 2020 before COVID hit. And I don't see that fad going away. I think we had probably overissuance in the short term of SPACs, but I think given that we are in a liberal environment, or that the Democratic Party is in control right now. And I also, one of the, I'd say, risks I see going forward is the lowerance of totalitarian states. I think the G20 really, when you look at Governor Cuomo, he really took, in my home state, a more totalitarian dictator view of how we were going to live our lives. And I'm curious to see how that unwinds. And I think the regulators are going to be pushing to get more regulation here than less. So I think SPACs are here to stay because it's an easier way to raise capital and also deploy that capital into the private sector or public sector. And I think it's put pressure on private equity and venture capital as they're starting to outbid them with some of these larger SPACs. That said, I think both public and private, it's it's going to be more stock picking or individual sectors. I think for private sector investing, when you're looking at a long-term play, it's either going to be healthcare or technology, as that is, I see as having higher profit margins and stronger free cash flow going forward. And if you've got a 5 to 10 year window, that would be probably the more opportunistic private sector investment.
Gotcha. Yeah, the SPAC evolution has been interesting. From my seat, obviously coming from the traditional world at Goldman, now being full-time in crypto for several years, watching that emerge and watching people really focus on a bunch of different sectors, including cryptocurrency and blockchain. I've probably fielded a call a week from someone who has a fintech SPAC or some sort of SPAC, and they're interested in learning about what kind of crypto companies are SPACable. But they lack kind of the domain expertise. So I think there's going to continue to be some shakeout there as well, and some refinement, as we've seen with recent regulatory action and responses to that and things along those lines. You mentioned technology, and obviously that's an area that everyone here is interested in. I hate saying let's double click on that, but let's double click on that. I'd love to hear what kind of, so you say technology is an interesting area. Let's break that apart a little bit. So what themes, what areas within tech are you seeing as interesting?
I think technology should be on everyone's eyes right now as we're kind of waiting. And I'd say most of our investors that we work with continue to raise the flag of, this market has gone straight up. When are we going to have volatility? And I think once we do have volatility, I would be looking to increase or overweight technology. And that also can be geographical. I mean, if you look at China and you buy a Chinese fund, you're primarily going to be buying a lot of technology names, probably their top holdings. And I think 5G is an interesting thesis there. I think we all kind of know the work from everywhere thesis is really one of the 2020 trades, but I think it's primarily going to be accelerated even more with 5G. I don't think people understand the dynamics of 5G and the aspect that 4G versus Wi-Fi, obviously everyone wants to be on Wi-Fi, but 5G is going to be about 50 times faster than Wi-Fi. And the ability to really work from anywhere, whether it's a backyard, Central Park, a beach with tablets or laptops, and have basically all the data you need streaming at that level will be game changer. And I think we'll see more and more usage of 5G that through autonomous vehicles, through AI, through cloud, that we're, I think, in the beginning stages of the fourth industrial revolution. And I think we're slowly just starting to see the blurring lines of the physical, biological, and technological movement going forward.
I love those analogies about the different kind of ages. I think I mentioned this on our last talk when our roles were reversed, but the different ages that we've kind of lived through as human beings, and everything from the agrarian to the industrial age to the technological age, and the age of obviously capital and abundance of capital, which has never been larger than it is right now. And what does that mean for where we go next, and how resources and capital get deployed, and in what ways? So I think that's really spot on. Okay, let's turn to vehicles and ways of approaching and accessing different asset classes. Specifically, you've continued to see a growth in alternative investments, alternative asset classes, that people have thought about ways they can seek out, whether it's yield or appreciation opportunities. What are your current views on alternative investments kind of broadly, and then maybe some pockets within alts that you think are interesting from an asset class or an investment strategy standpoint?
I think on a macro level, alternative investments are a necessity now, given that fixed income that was kind of always the part of the balanced portfolio is not a viable option, I don't think, going forward. I think rates are going to continue to rise. That kind of takes that core weighting in people's portfolios out, and they're going to need alternatives, whether it's for fixed income or for capital appreciation. So I think it's a growing segment. I think funds like yours that are continuing to have nice fund flows are going to continue to see that. As I think people looking at alternatives are going to want not the go everywhere strategies. They're going to want to fine tune it. And I think crypto is a very interesting area. I think fintech that's part of crypto is, I think, the 2021 kind of evolution we're seeing right now is banks are being disrupted by individuals like you who are helping to push this new revolution in how individuals bank. And I see especially on hedge funds, the ones that are gaining the assets right now are sector specific and very core concentrated managers that aren't macro managers, they're micro managers, whether it's technology, healthcare, fintech. Those are things that interest me. And on the private equity side, I think as well, the KKRs and the Carlyles that have their 18th vintage are part of the equation. But I think high net worth individuals want direct private placements now, as they can access them through the more regional banks or private equity players who understand the need of the investor.
One more before we go to some questions, maybe from the audience. What are your views on ESG? It's actually top of mind, and this came to me just now. So Kathy Matsui, who was the chairman of Goldman Sachs Japan for a number of years while I was there, just announced yesterday she's launching the first ever Japanese ESG venture capital fund. It's been a topic of discussion for a number of years. We actually acquired an ESG and impact investing firm when I was at Goldman, and I think that trend has only accelerated, and different technologies support that, including blockchain and cryptocurrency, and enabling more efficient use of resources and energy and things like that. What are you seeing from, whether it's from your clients or from investors, or just in terms of opportunities around kind of ESG and social investing?
I think it's great that there's a catalyst for it. And we're seeing governments really push that initiative. I got certified as a green advisor in 2012. That I thought we would have a catalyst then, and it took almost a decade for it to emerge. So I'm glad that SRI and ESG strategies are becoming an everyday subject matter with our client base, and we are seeing it pick up more and more. I also think it's demographic. I think the cities or the coastal areas, our client base wants to see it, while maybe at least in the US, the central states aren't as optimistic on it. But I think the bulk of the wealth in the United States is on the coast, and there's massive initiatives and want for change here. And I think the fact that the private sector can initiate that change is more important than the government.
Okay, great. Well, thank you so much, guys. We're on that 20-minute mark, and got questions coming in. I'm just going to ask my own question, actually, Baker, just on the subject of SPACs. I mean, the UK, as I understand it, I'm not in finance, but as I understand it, are a little bit slow on SPACs. Why is that, if that is the case?
Oh, that's a good question. I'm not sure I'm the best person to answer that, but I think the regulations in the U.S. pushed the SPAC market. The SPAC's not a new invention or a financial instrument. It's been around for over 25 years now. I'd say most of the SPACs that emerged in the late 90s, early 2000s blew up. And I think that put fear in the average investor's eyes going forward. This was not the right financial vehicle for them. And I think the reemergence of it in 2018 to 2019 in the US, it's such a more robust public capital market, allowed us to be the guinea pig. And I'd say there's going to be some failures, but I think overall a lot of success here with that market. And I think it's just the aspect that the public sector or the public markets here are so much larger than in the UK.
Okay, very good. So we've got various questions coming in on various elements. So I'm going to, Melissa, Charlotte, if you're happy, I'll ask these questions on your behalf. But so Melissa, first, actually, this is a good question for Matthew, but Baker first. What are your thoughts on the gold price?
I think gold has been lagging where it should be the last 24 months, primarily due to crypto winning that allocation as people are looking for non-correlated assets. And I think we've seen a correction here in primarily Bitcoin that I think has elevated the price the last 4 weeks on gold. And I'll let Matt speak more on that because he's more the expert than I am on crypto. But I think gold will continue to go higher here.
Yeah, Melissa, it's a great question, and Baker hit the nail on the head. So gold should have acted a certain way last year, in the way, frankly, you saw a lot of risk assets, including crypto, act, and it didn't. So the question is, why is that? And the answer, Baker nailed it. So crypto, specifically Bitcoin, the term I use is eating gold, and it's eating gold in a pretty linear fashion. And that's going to continue unabated the same way, Amazon ate physical bookstores and other technology have unseated far outdated incumbents, and Bitcoin in every single way is harder, faster, smarter, and a better and a harder asset than gold, which is a 2,000-year-old, dumb rock, basically. So I think that's going to continue. There will be volatility around it, which are opportunities for the right, kind of investors. But, the idea that crypto is going to continue to, as its first sort of point of consumption, consume that gold market, which is roughly $10 trillion. I think that's going to continue unabated. So I think my view is you're going to continue to see gold as an underperformer as more and more of the world come around to this realization, whether it's Stan Druckenmiller, Paul Tudor Jones, a lot of gold bugs that I worked with in my former life have realized that, maybe it's their entire gold allocation, or maybe even it's just a part of it, but that rotation out of gold and into crypto, specifically into Bitcoin as that digital store of value, digital gold, that's only going to continue as you get more avenues for people to do it, like a Bitcoin ETF and its availability on more platforms and all those types of things. It's a good question.
Okay, good. And so Charlotte, I'm just going to read your question if you're happy for me so to do. So Charlotte was interested, Baker, on what you said on technological advancement. So how do you think this will impact the geography of wealth, i.e. getting around corruption to make it more mobile and being able to drill into the third world economies? You got a view on that?
I do have a view on. I think as the fintech revolution occurs and we watch companies like Swift, who internationally are the way we move cash, kind of like a Fedwire in the US, it's going to be able to be tracing everything. If you look at the cash receivables industry, that is a multi-trillion-dollar industry. There is massive fraud in the emerging markets. Some countries have up to 10% cash receivables fraud. And with blockchain technology, we're going to be able to trace the bad players and feed them out and make a more transparent marketplace for investors, and also more peer-to-peer lending for investors, or peer-to-peer businesses done via the internet or applications. So I'm very optimistic there, but with the generation of wealth, there's no question that there's going to be haves and have-nots here as these companies disrupt so much old school business models and generate so much free cash flow. So I am nervous on the aspect that the 1% will get wealthier here off these technologies, but I'm also optimistic that the Robin Hoods of the world are going to help allow the middle class to take opportunity here and invest in those trends.
Okay, thank you. So Matthew, I'm just going to, I know you have to dash for an airplane, so I'm going to put two questions here, one from John McCormick and then one from Regina. If you need to leave, Matthew, I'm going to say thank you so much right now for
Thank you, Matt.
Not only the other day, but today, and also for answering all those questions you took from the forum members. But John, good to see you there. Can we bring you in for your question to Baker? I know the two of you know each other well.
Yeah, I think it's always good to get an update on the institutional limited partner. That's a class of investors away from the traditional 2 in 20 model for both hedge funds and private equity. We see it all over the place. Be interesting to hear your view on, what's the latest and greatest in that trend.
I think fee compressions is not going to end for a while, as there's more and more competition here, whether it's active management or, as we've seen, the ETF revolution that's occurred the last 15 years. It's really brought costs down. I think for alternatives like private equity, you're seeing more and more funds go to the 1 in 10 or the 1 in 15, and I think it's just part of the business model that we're going to see compression there. Unless you've got an amazing track record that's 30 or 40% after 3 or 4 vintages, it's hard to keep a 2 in 20 model. But if your net performance is stellar, I think you're going to keep it.
So, John, are you happy with that, or would you like to come back?
Yeah, that's great. That's very consistent with what I understand. Very confirmatory. Thanks, Baker, and good to see you.
Thank you, John. Good to see you.
And so, Regina, yeah, I see you're off camera there, but are you happy to come forward with your question, please?
Something disappeared.
Oh,
Hi there.
good. Where are you?
Hi, everyone. Yeah, just a quick question for venture funds. Quite a few of the institutional LPs have an emerging manager policy. Given the current climate, how realistic it is to access these funds for venture funds? Baker, if you comment, would be great. Thank you.
You're asking on the aspect of venture capital investing in the emerging markets, or emerging markets investors looking to invest in the US? I'm just trying to get clarity there.
Emerging managers in a venture fund.
Emerging VC is not one of, I'd say, one of my greatest specialties, although we see a lot of the deal flow, but I'm not probably the best person to be answering that. To be honest, it's just not one of my specialties, but there's a huge emergence of new VC players coming in from globally. We've seen it in Europe. I think the Palo Alto crowd is starting to realize they're not the only ones in the room anymore. We've seen a lot of Germans come into venture capital. I think they tripled their market size of venture capital last year. And I think you're starting to see it in the Asian markets and the Latin American markets, where you're starting to see more access there as well, with managers starting in those local areas. But I'm just not the best person to probably be answering that.
That's great. Thank you. Thanks, Baker.
Regina, good to see
Thank
you
you,
there.
Regina.
Likewise. Thank you.
Good to see you. Good to see you. So I'm just going to finish on one sort of macro question, really, Baker. And that, you know, everything we read over here is that there's the Biden administration's taken a big risk. You know, there's a 1.9 trillion stimulus bill, and that takes it to sort of effectively 6 trillion worth of spending in the last 18 months. You know, the danger, and of course we sit here in the UK and Europe, and we need to know what's going on in the US because it spills over here. But you know, the danger is that rising debts, inflation, central bank maybe losing a bit of credibility. You know, how does it all look your end? Is it going to happen? Are we going to have a bit of a crash?
I think the aspect that he'll get all of his stimulus done is low. I think there's enough pushback even within his own party that 6 trillion seems it's going to be a hard number to get to, and I think that will create volatility in the markets because it's already priced in to the markets as we're 6 months forward looking, at least on the equity markets. I do see, though, what he's already accomplished as it's going to make the dollar continue to fall. So I think, you know, the euro should rally here. I think the U.S. investor base is also looking at the European markets and the emerging markets as a whole is probably the better place to be allocated for the second half of this year, given the currency play and also the valuation play. The U.S. is trading by far way ahead of its European counterparts or emerging markets. And I also look at China on the aspect that they'll grow at 8.5% GDP versus the US probably 6 to 6.5 as the leader here going forward, at least for 2021. And I think their equity markets that haven't really rallied much this year will have a strong second half.
And what do you feel about the UK economy? You talk there about Europe, you talk about China, you don't mention the UK. You know, we're no longer Europe. What do you feel about the UK?
I think you're in a great position right now, given that you're not tied to the EU. So I am optimistic on the aspect that the UK is not tied to a membership base. That I think you look at the vaccine, it took forever for them to get that done because they needed all members to vote on it, and then they nickel and dime Pfizer and Moderna to get it lower, but they stalled their opening of their economies. So I look at the UK as a beacon of hope in the European markets or the EFA markets, but I think there's still a lot of uncertainty given there's no true clarity yet with how you guys are going to run. I mean, it was kind of like when Biden won the presidency, but we didn't really know his vision yet. And now we know what the vision is, and I think some of us are startled by how grand his vision is. But I think there's still a lack of clarity or transparency in the UK, especially with the political movement of how you guys are going to choose to be run.
I don't think we're ever going to quite get that clarity of vision with our current leader, but he may well be with us for a very long time. if nothing, because there's absolutely no alternative to him. Anyway, on that either optimistic note or very pessimistic note, Baker, it's always really good to see you. We cannot
Pleasure.
wait to get over to New York, and you will have seen in the emails there that we sent out recently that we're planning to be there in October. So everybody's welcome. We're going to run a really, really fun week in New York in October, and Baker, we look forward to seeing you then. I know you've got a big birthday coming up around that time. Look forward to that
Thank
too.
you.
But thank you so much for everything. And can I just say to everyone that next week on Tuesday, we're talking on the future of education with Dan Sandhu, forum member. And then on the Thursday with Jamie Metzel, who is currently our most celebrated forum member, as he was the lead story in the Sunday Times last week on the Wuhan situation, because he was one of the first as a special advisor to the WHO to say back in April of 2020 that he didn't think that it came from a wet market. And so now obviously that's suddenly that thought has been taken up by the Biden presidency. And there he was, front page of the Sunday Times. He will be talking to us as a fellow forum member next Thursday. For the time being, thank you so much, everybody. And thank you, and have a very good weekend. Thank you. Bye-bye. Thanks, Baker.
Thank you.